So, good morning, everybody. I hope you can hear me well. In case you don't have it, please take a headphone so that you can hear us. You can hear the presentations. Here you can hear me. So, a very warm welcome for the energy price session today. My name is Martijn van Gemert. I'm a strategy director at Vattenfall, and I'm quite happy to moderate this energy price driver sessions today. The program today is, which I really like, it's quite diverse. So we have like multiple angles of the same topic. So we're gonna have a presentation which is hitting a bit more on the general energy transition drivers, focusing from a more investor's perspective. We have a little bit more technical analysis on the different commodity drivers, but also like more deep dive on the German market. So that's what I really like. Unfortunately, we have one cancellation. Supposed to be UK energy transition presentation by Matthew Monteverdi from Argus, and unfortunately he is ill today. But Andrea Savacci from UniCredit offered to actually give his opinion and give a small presentation just before the coffee break. That means we have a coffee break either at around 11 or a little bit earlier, and after that we come back with a panel session. So for the rest, I don't have too much to say actually. So I would really look forward to an interactive session. If you have questions, you probably the speaker will tell you how you want to take questions during the presentations or slightly afterwards. So the first speaker will be Sebastian Lungwald. Please come to the stage. It will be a presentation about the impact of the energy transition on capital markets, and he's an energy analyst at Carbon Tracker Initiative.
Great, thanks very much for that kind introduction, Martijn. As mentioned, I'll be talking about the impact of the energy transition on capital markets and utilities, and touching on a couple of price drivers as well, which is going to be a bit of a challenge given the 15-minute slot, but I'm going to make some broad level observations that we see, and really I'd like to address some of the interplay between these areas in this presentation in particular. So for those of you that don't know us, Carbon Tracker is an independent think tank that does work on the energy transition and looks at trying to improve investor understanding of risk and opportunities in the energy transition. We work across with a number of different stakeholders, including various parts of the investor community, energy companies themselves, financial regulators, as well as policymakers. Really trying to understand the implications of an environment of a lower fossil fuel demand environment, and also trying to reflect the climate ambition set out in international climate negotiations. So really I'd like to start with the question, quite broad question, of to what extent do capital markets matter to utilities, which is a fairly obvious one. Well, the answer is, in short, a lot. If you think about how utilities operate, capital markets are largely interwoven into the very fabric of how they operate. For instance, utilities do make extensive use of debt financing for capital-intensive projects that they may make, or to actually operate the business themselves. A number of EU utilities are also listed on exchanges, obviously, around Europe, and represent around 3% of major equity indices. So that link between investors and utilities is certainly strong in Europe, more so than in other regions of the world. And investors have largely benefited from this link in the first decade of this century, when they saw the utilities outperform utility stock market by about 60%, as investors were attracted to utilities for stability and income, essentially. However, we've seen a markedly different picture in the last, since the turn of the decade. We've seen utilities actually underperform European stocks by around 30 to 40% on aggregate. We've seen near halving of market capitalisation within a decade in the sector, and also on the right hand side you'll see a large amount of asset write-downs experienced by utilities as well, which is obviously due to a number of factors, not to exclude the rising market share of renewable energy as well. So given these economic pressures that we've seen, or financial pressures I should say, over the last few years, I really want to hone in on coal in particular and the economics of coal in the European Union. We did at Carbon Tracker a study last year on the asset level economics of coal-fired power generation to see on a plant by plant basis to what extent are they cash flow negative or positive based on in-market, out-market revenues, as well as the long-run marginal cost of plants. And some fairly interesting results came to the surface of that research. When 2017, we estimated around half of the coal fleet in the EU was marginal or cash flow negative. In 2018, we saw that picture actually decrease to around 70%, given mainly the rise in carbon prices, which has been spoken about already in European Utility Week yesterday. But the striking finding is that by 2030, we think that coal-fired power plants will become economically unviable over time mainly due to 2 or 3 price pressures, which I'll talk about in the next few slides. So let's have a look at EU carbon prices, which has really seen a dramatic increase over the last year in particular. And in this period we've seen a near breathless 12-month rise in carbon prices, with a rally coming up to around 500% of what it was in May 2017 up to September of this year. Even despite the recent downward decline that we see in the graph to the right, we're still up. There's still a doubling of what we were at the beginning of the year. So clearly this is an upward trend, and we think this is due to one factor in particular, and that is the introduction of the EU ETS reform in the Market Stability Reserve in the EU ETS. And this is significant basically because for the first time the EU ETS will have a mechanism that will be able to modulate supply in the EU ETS and to enable its original intention, which is to have a fixed reducing supply in the face of varying demand. So let's look at the market balance over time and look at this in context. As many of you will know, we saw an incredible glut of allowances since the economic crisis to 2013. Backloading to some extent took a lot of EUAs out of circulation, which tightened the market somewhat, but however didn't ultimately deliver a meaningful price in the EU ETS. However, from January next year, when the Market Stability Reserve starts, we see a significant tightening and supply squeeze in the market. The Market Stability Reserve will take out about 24% per annum of the EUAs in circulation, to the tune of around 1.5 billion tonnes. Which again we think will cause the biggest supply squeeze the EU ETS has ever seen. And for that reason we think that EUA prices are only continue to go upwards over the over the short term. So why does this matter and why is this relevant for power generators? Well, if you look at the supply squeeze that this would generate, you need to consider the power sector is structurally short in EUAs, just generally in the EU ETS. And the supply squeeze is at its most greatest when auction levels are at their lowest and the forward hedging requirement is still significant. So we believe in that case that fuel switching will be the largest source of the supply gap squeeze, to meet that supply gap squeeze in the EU ETS. And as you can see in this stylized chart, we have the short-run marginal cost of coal, lignite and gas at various efficiencies, And in order to enable that fuel switching, what kind of EUA price is implied by that fuel switching in order to switch the merit order between coal to gas? Given that this large supply squeeze that generators will need to bid up these EUAs to a price level that encourages fuel switching, to also reallocate market length from the haves, which are typically the industrials and to some extent speculators in the EU ETS, to the have-nots, which are the power sector, as I mentioned earlier, and to some extent the aviation sector. So we really see an implied price of a range between 35 to 40 euros over the short term to really enable that, to meet that supply gap and for that emissions abatement to happen. Now, obviously, there are a number of caveats to such a forecast. Dynamics of commodity markets are an ever-changing landscape. You need to consider, obviously, the location, the availability of CCGTs in the system, and the thermal efficiencies of coal and gas, which are obviously very sensitive to this carbon price. However, we think the point still stands that we think that the fuel switching in the power sector is the largest single source of emissions abatement in the EU ETS, given this supply squeeze that I've outlined in the previous slide. So given the economic pressures of this on coal in particular that this presents, at Carbon Tracker we aim to look at what this may mean for utilities and or countries in order to understand what the potential risk metric might be and what we define as stranded value. Now, stranded value at a very high level really just implies the net present value of cash flows, the delta between them in two different scenarios. So in a business as usual scenario and in a Paris aligned scenario. So underpinning this logic is really the case that in a carbon constrained framework, that the least economically efficient plant gets phased out first. So just to give a couple of high-level schematics on what this means, we firstly identify the generation requirement in over till 2030 of coal-fired power generation in a region. Then we rank those assets from our asset economics modelling in terms of profitability, and then we calculate the NPV of free cash flow based on the lifetime of plants to arrive at the stranded value. Now, to arrive at some of the high-level results of this, you can see at the bottom we've got the top 10 countries by coal capacity in the EU, and you've got stranded value on the y-axis. You'll notice that stranded value is actually in negative numbers, and this purely just reflects the nature that I outlined earlier, that we believe that the economics of coal will deteriorate over time, and as such it will be cash flow negative. So really you can think about this, which you might think is counterintuitive, but the minus simply implies that companies or countries can phase out coal, can avoid financial losses should they phase out coal in a manner consistent with the Paris Agreement. So as you can see, there's a very wide variety in terms of results. Germany obviously representing around 12 billion, and we think they have the most to gain from such a scenario using this particular metric. RWE making up the largest portion of Germany there. But across the EU we see around 22 billion in stranded value, and I think the point here is to emphasise this is not a prescriptive "this will happen" or "this is the risk borne by companies or countries today" rather, but to really just to emphasise for investors to use this as one of many tools in assessing their climate risk in their portfolios, which they're increasingly becoming more cognizant of. Only recently did you see the largest pension fund, private pension fund in Norway talking to RWE about alignment and coming out of coal, and coal actually becoming blacklisted on several investors' portfolios requirements. And the last point I'd like to touch on is the market driver that I've heard already so much about in yesterday's sessions, is the incredible observation of renewable costs declining over time in Europe, and the observed rapid rate that's happening. So on this graph, we've got the long run and short run marginal costs of coal in a stylized format, and we see that if we see three inflection points essentially. The first is when renewables all in versus coal all in, i.e. the LCOEs are at cost parity, or when renewables outcompete coal on an economic basis. We believe this is already to some extent a done deal. We've seen many observations across the EU that this has already happened. But the second inflection point, which is the one I want to touch on here, is when operating coal-fired power stations become more expensive than deploying new renewables. And we think this will have a profound impact in the power sector. And we see this happening around mid-20s for solar PV and for onshore wind. So really, I think in conclusion, the risk drivers that are emerging for coal-fired power generations are clear. The direction is certainly clear. The speed of travel to some extent is already clear, given national phase-outs of member countries, as well as carbon pricing and stipulations by BREF on environmental on pollutant emissions will only decrease the economic viability of coal over time. And we think that given these trends, there are many utilities that can start to think about adjusting to become more resilient over the future in order to adapt and ultimately deliver value to shareholders, at least from an investor perspective. So there are many cases in point that this has already happened. You can look at people like Dong, or now Ørsted I should say, Enel, Iberdrola, SSE in the UK, and I think there's a lot more opportunity for that to happen across the EU. And on that note, I'd like to thank you for this presentation.
So, I think I grabbed the mic here. So thank you very much for your presentation.
No worries.
Very inspiring. I think we have some time for questions in the audience. And I have this thing you can actually use. Is there anyone who has a question for you?
Yeah, at the back, I think.
How it works?
Hi. I had a question to the carbon price development, because basically the EU policy should limit the oversupply. So we should come to equilibrium where supply meets demand.
Mm-hmm.
Do you think in this environment the prices can still rise, because it comes to a point where there's not a need for a new EU ETS because you're just in equilibrium? And this, last year, well, basically this year, the prices were rising based on it, like there are not enough EU ETS, not enough emissions, but I never read that there is a lack of them. It's just it's equilibrium.
No. Yeah, it's a very good point, and we've increasingly seen a glut of supply allowances since really the start of phase 3. So what I would emphasise is that to date we haven't seen any reason to say there's a shortage. However, the introduction of the Market Stability Reserve, which will come into force as of January 2019, we believe will have a dramatic impact in delivering a supply squeeze in the market, which, given that the power sector is short already, potentially not over the next 1 or 2 years given forward hedging, but we think that this will increasingly happen over time in terms of upward pricing pressures in the two EUAs.
So it means basically the power sector is currently now not having enough emissions.
We see there's an increasing supply gap on the power sector, given that they need to purchase from auctions, and given that the MSR will take out allowances out of circulation. The lower auction levels will cause that supply squeeze to require emissions abatement in the power sector, either in the form of reallocation from those that have EUAs, i.e. industrials, which typically get EUAs for free, and to some extent speculators that are entering the market, given the rapid rise in carbon prices this year. So we see those trends having an effect on the EUA price in going upwards over the short term.
Okay.
Hope that helps.
Good.
Yep.
Any more questions here? Right.
Thank you. Maybe just one quick follow-up on the kind of the coal abatement and at what price that changes. When you look at companies like RWE, etc., there's a lot of indirect cost in terms of labor and in terms of, you know, not captured by the pure operating cost of lignite or whatever. So how does that feed into the price at which real utilities actually switch and turn off their coal? I mean, what's that kind of, what's that price brand when you take into account all those indirect costs?
Sure, and a good question. I mean, the stylized chart I showed earlier was on the short run marginal cost, which often dictates dispatch decisions. On the long run marginal cost, which is going to include labour, etc., that varies quite significantly between regions that we see, and would imply different prices in different regions. And you touched on lignite as well. I think lignite, given its very cheap fuel cost, is going to be increasingly hard to enable that fuel switch. So we would expect the main fuel switching to occur between a medium efficient gas plant of say around 45% to a coal-fired power plant around 38% for those levels that I highlighted earlier, and for those EUA price levels to enable that fuel switching to happen. But on your point on labour, that I can't give you an explicit number.
Maybe a question from my side on slightly longer term. So when you could argue that in the end the CO2 price is not the main driver for abatement, because you also see a lot of forced phase outs of coal. Taking that together with the increase of renewables coming from cost reductions and the will of politicians to include them, what will be then the investment climate look like? I mean,
the short answer is a lot trickier to tell. But no, I think the reason why we try and show the near term is because, given the capacity, the idle capacity of gas-fired power plants already in many places like Germany, Spain, Netherlands, to some extent, and Italy, that over the short term you can determine that fuel switching is probably the most economically efficient way of abating emissions. However, over the long term, as you rightly point out, with the introduction of phase-outs and more permanent abatement options from renewables, it becomes increasingly difficult to understand or have visibility over those prices and where that abatement might happen. So you're right to pick up on those many variables that exist that can really influence the dynamics of that market.
please, one question there. So, should I or should I not? There you go.
Hi.
Hello.
I was wondering what you just mentioned, that you mostly expect the fuel switching to then happen between gas and coal-fired, but that kind of still leaves lignite in the mix and doesn't really drive as much abatement as you'd hoped for. So when does lignite disappear, or is that always going to be the last plant going unless politicians actively intervene?
Yeah, so good question. I mean, lignite, as I mentioned earlier, benefits from very low fuel costs compared to hard coal plants. And typically in places like Germany, where you've got the open mine next to the power plant themselves, you don't have to incur transport costs of the fuel as well. So given these cheap input costs, it's more difficult to incorporate that or to get the fuel switching from lignite, and I think you're going to have to see EUAs going up further still to that price range I mentioned earlier for that fuel switching to begin to occur away from lignite to gas.
So above 40?
I would say so. I'd say you'd have to go above 40 to really start to imply it. Based on the forward curves of gas and coal at the moment, I think you'd have to look at something like that, yeah.
So great. If there are no burning questions in the audience, then I would definitely like to thank you very much for the inspiring presentation and your active participation here. And then I propose actually we go to the next speaker, and maybe you can push it. Yeah, that's Volker Kraaienvanger from Uniper. and he prepared actually a speech on the more fundamentals of energy commodity price drivers in a more international, global context. So, please take the stage. Thank you.
Thank you very much, Martin, for your introduction. So, what I would like to do is I would like to present something about the complexity of the energy commodity price drivers and how they are actually increasingly interconnected both regionally and across the commodities. So particularly where we have an environment where commodities are driven outside the region, for instance, we see China as a major global energy player who's influencing prices and commodity prices to a large extent, it becomes rather very complicated to really see the magnitude of these trends, how they affect commodity prices. And we see also that not only single factors are influencing prices, but also commodity prices across each other. So I think the difficulty is to take a step back and to see to what extent, to what magnitude are price drivers driving prices, and to what extent they are interrelated. So if we take a step back, we see, of course, that we have a lot of fundamental price drivers. Of course, economic growth that is driving prices, commodity prices. The larger the growth is, of course, industries and economies, they are much more hungry for energy. Certain investments, they drive prices, especially on the supply side of the curve. Infrastructure constraints, they can also drive prices. Weather is always a wild card. I will tell something about that in a later stage. Policy regulation, that is something which is very important. Technology, geopolitical events, exchange rates, which are not on the list. So there are several price drivers which are driving prices. If we take one example of a single driver which was very dominant, it was the Fukushima accident, which basically has not only driven prices, of course, in Asia, but also across other regions. And the reason for that is that about 49 gigawatts of power generation, of nuclear power generation, they went offline until 2013. And this was balanced by a mix of different things. Of course, there were demand-side measures which balanced this shut-off of the nuclear power plants. There was even some oil capacity plants which were generating power at the time, but the large extent of flexibility which was provided on the market was coming from gas, was coming from LNG imports, which Japan needed to import more in order to secure the power supply. And some of that flexibility, came from partners, from counterparties, which they were engaged with, like Qatar, but also a large extent from that flexibility came from Europe. And so we see that regions are basically very much interconnected. And the reason why it came from Europe was that Europe at that point in time, they had excess gas capacity or excess gas imports because they had a large and very sharp increase of renewable energy at that time. So that could free up some of the gas volumes they were originally destined for Europe, which could be then re-exported to Asia. So we see a price spike, of course, after the Fukushima accident, but what I try to elucidate is that this price spike could have been even higher if the flexibility from Europe would have been there. Another single factor, and I will talk about that a bit more in the next slide, is of course the shale gas revolution, which does not only influence North America, but it also influences and will influence other regions, and that is because this shale gas, which is produced in the US, that will be exported via LNG, because the US is heavily increasing the liquefaction capacity, and this will give a close link from the US North American markets to other markets. So I will now go a bit from the west to the east. So I start in the US with the shale gas revolution and explain a little bit how this developed and how difficult, obviously, it was to really have good forecast about what's happening there, because in 2004 still forecasts were saying that the US will be an importer of LNG, and they were saying that about 130 BCM the US will import LNG in 2025. They believe that 60 BCM around the US will import LNG by 2013. So the shale gas revolution hasn't been really recognized as a game changer for the US and for the whole global gas market. And in 2007, they started to recognize that something is happening in the US, but still it wasn't really detailed, and the view of what was happening in the US wasn't really there. And until 2011, there were the first forecasts which said, okay, we believe that the US doesn't need to really import gas, but their role will completely change, and this means that they will actually turn from an importer to an exporter. So it was a technology-based price driver, which was basically changing North America, changing the US, but also having effects on other markets. So this technology change, this game-changing driver was basically the possibility of the US producers to have hydraulic fracking, to have horizontal drilling, which allowed them to produce gas at a very, very low cost. And even if we saw in that chart down to the right, even when hub prices in the US were dropping down, the producers showed remarkable resilience in order to keep up their production. But now, to understand also, it was not only coming from the gas industry, of course, itself, but the relation to oil is very close, because if you look at the US, if you look at the different production reserves, you don't drill a well only in order to have dry gas, but there are a lot of wells in the Permian Basin in Western Texas, for instance, that are associated gas fields, which means that the oil price does trigger if a well will be drilled or not. So that means that increasing oil prices also have an effect on the gas, because if you have high oil prices, the trigger to drill a well is the oil price, and then the gas will come as basically another product out of the well. So you see that different commodities, different prices, they interact within with each other. So this is something also which needs to take into consideration when you evaluate price drivers. Another sector, of course, is the power sector, and this was in the US, in North America, another thing which basically changed a lot of the fundamental things in the US, having effects on the coal demand and, of course, on coal prices to a certain extent. So the resilience of the US gas producers and the possibility to produce at very low prices and the resulting drop in prices at the Henry Hub, of course, this incentivized gas-fired power production in the US. And you see in the chart on the left bottom that gas basically overtook coal in terms of their share of the whole power production. So this price driver has been recognized, or has been really seen quite late in the process, with tremendous influences not only in the US concerning power, but also connected to the global market, because the role of the US was completely changing from an importer to an exporter. We also see something like coal to gas competition in Germany as well, of course not to the same extent we see in the US. This chart basically highlights that prices, the spreads, the clean dark spread and the clean spark spread, they move a little bit in tandem in certain periods. For instance, in Q4 last year, we see that coal and gas prices moved quite close together. However, we see that some fundamentals in the European market also, they highly influence to what extent this change can happen. So, for instance, beginning of 2018, we had a quite late cold spell in February and March. You see the sharp drop in the clean spark spread, which means, of course, that at this point in time, this tandem relation was kind of broken up. This year, it didn't move in tandem really, because also coming from the gas side, storages compared to last year, they were less filled, which means that gas prices in Europe they were higher, which basically again decoupled the relation between the two. But what we see in Germany is that this competition between coal and gas, it's happening. To what extent it will happen in the future, it depends on a lot of factors. So moving further to the east, what we need to consider, and I think that is something which will probably be a factor for the next years, are countries like China, who have a large leverage on the global market and have a large leverage on what happens not only in the Northeast Asian market, but also in other markets like Europe. China, in the power generation sector, of course, dominates the coal market. It imports, the largest part of the coal trade is happening in China. So obviously, China's moving on the coal market does influence the whole market. But another policy, and this is something which is of course very difficult to determine, is the energy policy and also the environmental and climate policy or environmental and air quality policy, to be specific, is something which is heavily influencing the Northeast Asian part, but also the global market. So what China was doing is they presented a plan, the 13th year 5-year plan, which basically gave targets in order to clean air quality, which was a tremendous issue in Chinese cities. So they in 2015, for instance, they had like around 2005, they had like 2% of their whole primary energy demand, which was gas. And today they have a share about 6% of primary energy demand, which is fueled by gas. And in the plan, they envisage to have a share of 8.3 to 10% of primary energy demand, which will be gas. And everybody was quite unsecure how determined really China is in order to push that forward. And the last 2 years have shown that they are very, very determined. They are even more determined than they could handle within their country, because they have different sources how they can really procure gas. One is their indigenous production, but you see a quite difficult geology in China, which basically means that in the past years we've seen incremental indigenous production in China of about 10 BCM by year. Everybody expects that it's very difficult to really increase that much more, although they are increasing their investments. The reason for that is the geology in China is very, very difficult to produce more than 10 BCM per year. So this leaves for two other options, which is pipeline gas. Currently they are basically importing most of their pipeline gas from the Caspian region, but there are other projects, and this is another thing which now comes back to the driver's question, the infrastructure constraints. So they are building new infrastructure, Power of Siberia, to connect their demand with supply sources from Russia with pipeline gas. So this is kind of a driver which needs to be taken into consideration. But in the past 2 years, it was clearly LNG imports and their move to the LNG market, which was heavily influencing Northeast Asian prices and of course also global prices. So the determination of China to really push forward to improve the air quality in the cities, it's something which needs to take into consideration, and it's a driver which is fairly difficult to really determine. You have the plans, but in the end it is not really sure how strong China will really achieve their targets. But with the last 2 years, that determination has been proven by China. Another factor, and I've touched upon this already, so we'll put it short at that point in time, was Japan. Japan had this natural disaster, which was basically driving their LNG demand, which was affecting supply-demand balances in that region, importing more LNG, so prices increased. The question is how the power mix in Japan will change throughout the time, because they still have nuclear power in their portfolio. Of course, the acceptance is very, very low. The security standards have increased. So this is something which needs to be monitored in order to really assess how sustainable this demand from Japan will be, and when nuclear power and these kind of resources will come back into the power mix. If we talk about drivers, of course, we need to talk about the weather. The weather the weather is always a topic which is very interesting to talk about, and it drives prices, of course. I mean, if you look for gas, for instance, you see that cold weather definitely, of course, has an influence on the demand and on the flexibility the commodity needs to provide at certain times. This year, January was unexpectedly warm, wet, and windy. However, we had a cold snap in February, March, and you've seen it in the charts before. Of course, that cold snap had an effect on the prices in the gas markets. Spring actually didn't really happen, and then what we have seen throughout the summer was a very, very warm summer. In the charts, the colors, they basically say the deviation from that specific year, 2018, to the average, which is taken from 1981 to 2010. So weather is, of course, something which needs to be considered. And when it's not only the temperatures, of course, but it's also the precipitation. Because if you look at the energy mix, the power generation mix of a country, of a region, then precipitation does matter because it tells you how windy, how much water there, how much water there is for your hydro production, and this then affects also the other prices and to what extent other fuels will enter the power mix. So we had a lot of precipitation in January. Good snow conditions in the Alps, which it doesn't matter really for the energy market, but for your private life. So that was something we were looking on the screens when we were monitoring the weather. April, rapid warming then led to an abrupt melting of the snow in the mountains, and thereafter we basically had a pretty dry summer in continental Europe. However, we had some heavy precipitation in Scandinavia since August. So to conclude of the presentation, what needs to bear in mind is that energy commodities, it doesn't make really sense to just look at one commodity. They are interlinked, and they are increasingly interlinked, and they are interlinked not only across regions, but they are also interlinked across commodities. So understanding these kind of relations is very important, and it's also very important to understand how major energy players like China, how they act in the markets with their policy. Of course, this uncertainty will remain high because, for instance, for China, we can see how they have acted in the last 2 years, but of course, it's not really sure how their demand will look like in the next years. Weather and geopolitical events, as I said, they are major wildcards. It's very hard to predict how this will change. So flexibility is a prerequisite to be successful. There are several other things which need to be considered. I don't talk about in this presentation. We have heard it from Sebastian in the previous presentation. There are several national coal exit strategies across Europe which needs to be monitored and which can have an effect of the power generation mix. There are higher renewable energies, efficiency targets for 2030, so everything which is very important and needs to be considered. So Uniper actually doing that. We are a company which is active in 40 countries plus. We have a large portfolio of different commodities, and our job and our mission is actually to manage this complexity in the markets. So thank you very much for your attention, and yeah, happy to take questions.
Thank you very much. Well, the more international it becomes, the more interconnected it becomes, the more complex it becomes. My spontaneous question is actually, you highlighted some black swans and some very complex interactions, and we know there are many consultants who try to make some price projections for the longer term. Do you believe in them at all? Do you think it's possible?
Well, I think to a certain extent what needs to be seen or what needs to be looked at is all the assumptions which these consultants take. And of course there are a lot of sensitivities and a lot of assumptions about what if you screw or if you change that kind of assumption, to what extent does this change? So I think personally what is much more important is to understand what kind of price drivers they have included? Is there something you don't have on your radar? You don't really consider? If you have everything, then it is a discussion to what extent you believe these price drivers will really have an effect on the prices. But in the end, everybody has to make their own mind because I mean, you shouldn't just believe in a curve or just believe in a prediction. You should really understand to what extent the sensitivity is driving the price.
Thanks, but it was a quite general question. I believe there are more specific questions maybe for you. Where is the mic? I think the last time it was there, so please be invited to ask a question, and we can throw you the mic.
All right.
Anybody? No? Oh, sorry. Yeah. Oh, yourself. Yeah, please.
I can hog the mic, that's fine. I was wondering with respect to China, the chart you had in terms of LNG imports. Last year, yesterday we heard that they have increased quite a lot this year already. But you said there was some uncertainty about how much more China was pushing to go forward. What is your take? Will China continue? Where are LNG imports headed from them? Will they continue to drive prices as much as they have over the last 2 years?
So what we've seen in 2018, that this trend, what I've showed 2017 is continuing. So up to September, they already have increased LNG imports by about 16 BCM compared to 2017. So that is something which we see, at least for 2018. What I think we need to consider is, as I mentioned previously, to what extent China is able to diversify their supplies. And I mean, from the statements we read is that Russia and China, they are pretty sure that Power of Siberia will come end of 2019. So we can expect end of that year, actually beginning of 2020, to see more pipeline gas. But that is kind of a really significant driver to what extent China is really importing more LNG, because then if they have the possibility to diversify their supply and to import pipeline gas from Russia, that of course can have an effect on the LNG imports they need to take from the market.
So can I just double check? I think the slide you showed was 2017, was about 16 BCM as well, wasn't it? That they imported?
Yeah, could be.
And now you said it has also more or less doubled by September already.
So I need to look up into the numbers, and we can talk later about it. But definitely they have increased their LNG imports in 2018 by 16 BCM. So I think in 2018 up to September about 51 BCM they have imported. But we can talk about that later.
Thank you.
All right.
Yeah, here question. Two stages. Okay.
Thanks. Maybe one just on kind of LNG pricing, maybe more medium/longer term. As that market moves to more of a spot market, what is the impact on pricing longer term, do you think?
Well, I'm very cautious to say something about prices in medium or long term because it's very hard to predict. What we see is that China, they in the last year, when they had the cold spell, one of the issues why they went on the LNG market was that they have a lack of storage capacity. And that lack of storage capacity is quite significant compared to other markets. For instance, Germany, which is also a market which needs to import a lot of gas. But compared to China, the extent or the share what they have in storage is much more than China. So what they are doing now is they have some projects, and a lot of projects actually, in order to increase their storage. And because that cold spell in the beginning of the year, that forced basically Japan to go into the spot market, to go in the energy market and take the prices which were there, because they didn't have any alternative in order to provide the flexibility due to a lack of storage capacity. So within the project, and that is something where I'm very, very cautious, because I don't know how really the progress on those projects will be. But that will be a very decisive factor from China, how much they really are exposed to the spot markets in the future.
So, one question in the back.
Yeah.
Thanks.
My question is still in China, however, on their production. So, what do you think about their production potential? There's talk about shale gas projects in China, and so that's the question.
So if you look at the reports of some of the main players in China, and that's CNPC, for instance, is very active, of course, in the indigenous production. They last year invested, compared to 2017, they invested more. And as I said previously, we have seen in the previous years that the indigenous production of China was increasing by 10% each year. It's not really sure if they really can increase that 10 BCM each year really much more, because compared to the US, the geology is more difficult. So far, experts they see that China will have difficulties to, for instance, have comparable incremental production increases as in the US we've seen. So it's very hard because the geology in China is very much different and makes it very, very difficult for them to really increase the indigenous production much more than we have seen in the past.
And if you combine that development in Asia with the trends already described by the previous speaker, and also that in Europe indigenous production is also going down for gas. So you see like lowering gas production in Europe, more demand globally. And then taking that together with the trends from the previous speaker, what will be the impact on the European market and the power market?
So the European market, I mean, the European market is very diversified because they have a lot of possibilities to import pipeline gas with the existing pipelines and also with the projects we see. So that kind of diversification allows Europe to import from different sources, and that is very, very important. I think another thing which needs to be considered if we talk about Asian demand, we see countries like China and Japan, which we believe have a certain sustainability in their demand, but also in the Asian region, you have countries like Pakistan, like other countries. So the demand gets very much fragmented within Asia, and it's not really sure how sustainable that demand is, because those kind of countries, they're quite price sensitive and they might move away from the LNG market if they feel that the price level is too high for them.
Maybe one final question in the back before we go to the next speaker. Thanks.
We always talk about Asia, how they increase the LNG demand, and we never talk about Africa. Actually, is there any projection that Africa will start building LNG power plants, gas power plants? Will this play any role, or it's completely out of the table?
No, I won't say it's completely irrelevant, but it's very, very hard to see a really large push like in China. So a really large policy push, for instance, which really makes gas at the moment comparable from the demand side compared to Asia. So from the pure perspective of shares, Asia is definitely driving the incremental demand.
Thank you very much for your
Thank
presentation
you.
again and active participation here. So from a more global perspective, then we go to a more European and more focus on Germany by a presentation by Petter Hansen on market developments and weather-based scenarios. So thank you for coming here. On the program it says Thomson Reuters, but maybe you have to explain what's happening here.
Thomson Reuters is bought by Blackstone, so now we have changed name to Refinitiv. So that's the new name going forward. I'm heading up the team that is responsible for the weather-driven information service in Icon. So basically we are a service making forecasts for renewables for whole Europe tomorrow, next week, and also doing predictions, basically historical weather going forward.
Working? There was a slide, I think. Just push the. Oh, sorry, there was the wind. It's coming online. Yeah, it should work.
So I'm going to present this is a more specific presentation about the German power market, basically about the latest market developments, and present the weather scenario-based price forecasting for the 2019 and 20 contract. So starting with German Power 2018. So the yellow line is the Frontier 1 and the pink line is Frontier 2. And German Power have been very strong for last year. If you look at the time spread, which basically is the chart below, you see that the time spread have been very negative until it changed around September, where it had been ticking a little bit upwards. But this is really only a fuel-driven story. Is this only about fuel? So, as we already mentioned, I mean the gas prices has been low in Europe, have been high lately because of low storage, and basically as gas is on a margin, the clean dark spread has been improving quite a lot. But also you have seen an improvement in the clean dark spread. So this story is not only. This shows that this story is not only about fuels. It's also about the general tightening of the market. So basically, I'm going to give you some numbers on some of the questions that actually came up in the previous presentations. I will show you the price forecast, and as I mentioned, it's all about assumptions. So I will really focus on the robust results. I will present. A flat fuel scenarios. I will also present a coal decommissioning scenarios. We was talking about lignite here. So basically, what if we remove 5 gigawatt of lignite to Germany? What is the price impact? And then press on the drivers going forward and tightening the market. And at the end, I will give you understanding of the actually weather uncertainty for German power, which is also maybe applicable for other markets. So I'm not going to say too much about the model. It's a merit-order model. We're modeling the whole CVE area. We include weather, that will come back to in more details later. And we're using the latest the market fuels. So this is a forecast from 29th of October. We are bearish for 2019 and neutral for 2020. I'm not going to go into that, but what I think is the robust result here is basically that the time spread between 2019 and 2020. The time spread is basically driven by backwardation in fuel. But you see that the market has a time spread of minus 2.4, but we have a time spread of 0.6. But let's just look a little bit on fuel. So the time spread for carbon is very stable. It's basically zero. There was some extreme development during the very high prices we have earlier this fall. But in general, it's quite flat. In coal, you always see some historically. You have seen some backwardation. It's basically due to lower hedging going forward and so on. But for gas, we have seen a remarkable backwardation in fuel, and that was basically driven by the low storage levels in Europe. So basically, you have a spread of €3 a few months ago in September, but then you have a quite mild fall, and the storage levels is really picking up, but you still have this backwardation in gas. So yes, the backwardation in power, it's driven by fuels, but we also want to point out that we think that it's too high. If you believe that you don't believe in this backwardation in fuel due to different reasons, we have basically run flat fuel scenarios. So if we assume that the fuel prices in 2020 is the same as in 2019, what should the spread be? And our model suggests then a positive time spread of basically €1, which basically indicates a tighter market, a tighter supply and balance, supply and demand in going forward. And if you look on the generation mix, you will see that from the chart in the middle, 2020 to 2020, the flat fuels indicates then an increase in the coal generation and a slightly lower gas generations as the gas price basically goes up in this flat fuel scenario more than power. So why is the market getting tighter? If you're not looking on the 2019 and 2020, Germany will see a loss of 10.4 gigawatt base load capacity in the next year. The first one was already, we have a significant amount of lignite plants closing down now in October. But for 2019, you also have Jenswalde and Neurath C. And on top of that, you have Philipsburg going offline in December 2019. This is part of our base case scenario. But if you look even on additional uncertainty factors, which we hasn't priced in, you have the coal commissioning that will have a decision by December 2018, which mostly likely will affect the least efficient lignite plants. So maybe around 5 gigawatt closure by 2020. You also have uncertainty about new power plants in Germany coming online. It's not many thermal plants coming online, but Datteln 4 have officially the starting date in October 2020, which is part of our base case. I think it's a 50-50 chance that that's actually happening. In addition, you have issues with the lignite extraction. So there have been a court ruling in Hambacher Forest that they need to reduce their lignite extraction for some of the RWE mines, which basically will reduce the supply of lignite, which can have additional impact going forward. And then you have the BREF regulations, where you basically need to retrofit your plants to comply with the new NOx and the SOx regulations. So there is a lot of uncertainty factors on top of what we will call a base scenario, and someone will say maybe, okay, this will be covered by a more installed capacity in wind. But actually for the next years now, we actually also see a slowdown in onshore wind additions due to the new auction regime. There is some kind of a transition period now for the next year, where we have low additions. You have some new offshore additions to 2020, but this basically doesn't cover the lower thermal capacity. Okay, if you're looking further ahead, the pictures look different. There will be a lot of that, but it seems like we expect that for the next years, the additions will slow down a little bit and will not cover the decommissioning of thermal plants. And then just to give you a number again on the impact. So basically, if you're removing 5 gigawatts of the cheapest production in Germany, we assume that the cost of lignite is 1.5 euro per megawatt. Then you have to add the efficiency and also the carbon costs. But if you're talking about the level of carbon price, you need to make lignite not compatible. It's as you say, it's about 40. And also, if you remove lignite plants in Germany and the rest of Europe, you will also increase the gas supply, where there will probably be a feedback effect where you probably need to increase the carbon price even further. But removing 5 gigawatt have an impact around 3 euro per megawatt for the 2019 and 2020 contracts. And lignite generation then drops from around 40% of the total production in Germany down to 30%. This will be then replaced by coal and gas, but also lower exports. So there are some uncertainty around the policy uncertainties, but there is also a certainty uncertainties around the weather, which I find quite exciting actually. I think weather is what we're working on. So what we have done is that we have basically been creating weather scenarios based on historical CFSR data, reanalyzed the weather data from 1990 to 2015. So basically taking our assumption, capacity assumption about wind power wind capacity, solar capacity, consumption. We have run 25 scenarios for all these countries simultaneously. So we used the weather in 1991. What if the weather in 2019 is the same as 1991? What will the wind production be? What will the solar production be? What will the consumption be? And our model do a only forecast for the next 2 years, modeling all the border flows. It's a merit order, it's a detailed representation of all power plants. We include the new interconnectors. So what is the impact? But first, let's have a look on the why you actually need to do this when you do price modeling going forward. It's because, as already pointed out, the certainty in temperatures is high, you have precipitation, but in wind, the range is huge. So basically these charts show, given historical weather from 1991 to 2015, you have different scenarios with today's capacity going forward. And if you look on this range in January, so given, if you take the weather in 1997, you have an average production of 8 gigawatt hours in January in Germany. If you take the weather from 2007, you will have 27 gigawatt hours on average. Here we're talking average number. So basically 20 nuclear power plants difference. And you see that the differences are highest in the winter and the risk is lower in the wind and it's smaller in the summer. With June to be the lowest spread with around 6 gigawatts at the lowest and 11 at the highest. So if you translate this into prices, so basically you run our price model with today capacity expectations and the latest fuel inputs. The lowest range is seen in June. Then you can actually get the outcome of the June contracts as low as 42.1 up to 48.5. The range for January is 25 euros. So basically, if you have the weather in 2070, you have a 39 euro outcome. If you have the weather in 1997, you see you could potentially see a price of 65 euro. It gets a little bit even out of the air. So if you look at the Q1, for example, 2019, the spread is around 10 euros, while the lowest spread is seen in the third quarter, where the range is around 45 euro. If you look at the year, the weather uncertainty for the 2019 contract is basically 5 euros. The lowest was seen in 1994, using the weather in 1994, and the highest was using the weather seen in 1996. And the range for the 2020 contracts is on a similar level. We was also talking about precipitation previously. So the uncertainty, the weather uncertainty for the German market is around 5 euros for the yearly contract. We also have a different model for the Nordic market. It's a completely different market. It's hydrology. It's all about precipitation. So we have a different model that's basically optimizing the reservoir levels, doing stochastic dual dynamic programming. The result is not 100% comparable, but because if you are coming in a dry situation in a hydro-based system, it will continue right for a while. But the price range in Nordics is even higher. It's up to 20 euro for a year. So that's more like extreme, but it's quite very significant also in the German market. how many negative hours do a scenario forecast have? So what is interesting, we are talking a lot about the upside, but there is also a downside with increased renewable capacity, because if the residual amount, basically consumption minus wind and solar, it's basically covering all the demand, all supply in Germany, you will see negative prices. So what you have here is you have the different weather years. So basically the weather 1991 to 2015, and the number of negative prices. So it's ranged from 23 to 169. The lowest was the weather year of 2010 and 1994. I think the most important takeaway from this illustration is it's not really exact amount of negative hours, because that's more it's about assumptions again, but it's actually the randomness from year to year, that you can go from basically 20 to maybe up to 200 negative hours. But the average of our scenarios suggests 83 hours negative prices. And if you compare a little bit with that with what we have seen for last year, you have the chart below there. It's the amount of negative prices per month since 2019 until now. So the trend have basically been positive. But if you look on the right chart, you will also see that okay, the amount there have been more negative prices, but the extremeness of the negative prices is lower. So even though we have more negative prices, it doesn't go as low as you did before. And the reason for that is basically that it seems like the co-producer is running the plants more flexible. So on the right-hand chart, you basically have the lignite availability back to 2019. So you see that they have been quite stable. The red line is basically the red dots, and the green dots is the maximum and minimum lignite production in hours with negative prices. So you basically see that also the lignite producers is running their plants more flexible. So yes, you see an increase. You see a growth in the renewable capacity, which could give more negative prices. But you also have the share of the inflexible supply is decreases. You have nuclear decommissioning. You have the old lignite plants closing down, and also you have new interconnectors coming online. So we have better export possibility. So we don't necessarily see an increase of negative prices for the next years, and you also see that also the renewable producer is also starting to adjust a little bit. So basically, to sum up a little bit, we believe that the negative time spread is basically due to the backwardation in fuel, and due to the reduction of base load supply in Germany. It's basically a market the market is tightening, and we should basically see an increase in prices if you keep the fuel prices constant. There are some risks, additional risks, removing if we remove more coal capacity, and the impact of that is around €3. But the weather uncertainty is even higher for the market than this political uncertainty. We can actually see a price range of the yearly contract of €5. So, and negative prices, as I said, it's hard to predict. It's basically about randomness, but we do not necessarily see that trend, a trend of more negative prices going forward. So yeah, thanks. Sorry. Yeah.
Thank you very much. I think you always can recognize a good analyst if he starts to talk about the weather and the uncertainties around it. And I know that from my own experience, especially your Swedish background, I think the weather is extremely important factor in price driving. But not only in the Nordics, but also in Germany we experienced. So thanks a lot. We have some room for questions, of course. So anybody in the room? So you can start again if you're still holding it. Oh, you don't have it. You don't have it. So maybe to start off, man, if you look even a little bit further, given the weather uncertainty and also the increase in renewables going forward, so I assume that there's also a lot of flexibility needed somewhere in the market. If the market gets tighter, more renewables and uncertainty in the weather. So what would you, a little bit out of the box, what would you recommend policymakers on how to anticipate on this? I know it's not your primary profession.
I have a,
But it's always...
I would say that I don't have a clear, obviously not have a clear answers. I mean, batteries is options. You have interconnections to the Nordics, where you have big reservoirs. But unfortunately, I think you basically need to see some still some thermal power being online, basically to cover those days where you basically have no wind, where you have no solar. And that you will see that basically that will happen, and so investing in renewables, but you might have some kind of a market mechanism to keep some of the coal and gas plants online.
And I believe the German government is still believing in the energy market for the moment, so let's trust on that. Maybe in the meantime, well, that triggers some question. So can you give the mic? Give it to her, throw it.
With respect to your €3 megawatt hour figure for the lignite reductions, do you find that reflected in the current prices, or do you see that on top of the current forward curve?
I don't, as I was pointing out, that the time spread is now negative for 2020. It's hard to predict what the outcome of this coal commissioning will be. It will probably not be a flat 5 gigawatt reduction in lignite for 2020, but maybe more like a gradually decrease throughout 2020. But at the moment, I don't see that priced into the curve.
Okay, so sorry, I understood that 5 gigawatt was something that you already assumed would go offline, or that was already planned through the lignite reserve.
I think the realistic scenario is that 5 gigawatt could go offline by 2020. Maybe more towards the end than in the beginning. But my point here was basically to just test out, okay, what if 5 gigawatts gets completely out for 2020, what's the impact? So basically it's more like the impact for 2029, then we would see maybe a €3 higher than without. So
2021, 2029?
No, it's just to try to quantify 3 gigawatt, what is that matter for the market? I think when they get the conclusions for the coal commissioner, we will probably we will just include that gradually reduction in lignite and see the impact.
So, if there are no burning questions, I have one specific one actually, before and after we can move to the next speaker. One of your conclusions, of course, that the backwardation in the curve explained by the fuels.
Yeah.
But do you know how liquid is this fuel market in the forward market? Isn't it a little bit too illiquid to draw that conclusion?
Yes, I guess for coal, I guess if you're looking to your side, it's not that liquid. But even if but in our forecast, we basically do using the prices as we do, and based on that, we also think that it's too much backwardation in the power curve. It should be less. So even if the backwardation have been less also in coal, we still should think it's too much.
So thanks a lot. As already mentioned in the introduction, unfortunately we have one cancellation from Matthew Monteverdi on the planned UK presentation. But on the other hand, the positive news is that Andrea Savacci from UniCredit offered actually to give his opinion just before the coffee break. So we have 10 minutes, I think. And after the coffee break, we still have one interesting presentation by David afterwards. So I'm very happy that you can step in and you're willing to give your opinion or trigger some discussions we can have during the coffee break.
Thank you. I'm not sure it's that positive, but we'll see it afterwards whether it's really positive or not. But good morning, everyone. What I like to give is a bit of a different perspective of the energy prices, not from a commodities pricing standpoint, but from a participant's standpoint. What do I mean? I mean that we've looked at interesting presentations about power pricing and power, how they've gone based on the price of commodity, but what has happened in terms of participants, producers, distributors, consumers over the last 20 years, so since let's say 1999 when the market started opening up. When I started working at Gas & Power at the end of 1999, the market was just literally opening up with some decrease in Italy, Germany and so forth. And if you look at the scenario, it was made by very few incumbents, very few names in every country, and power prices were extremely, extremely high. Clearly there was discrepancy between one country and the other based on their accessibility from other markets. I looked at Italy, which was way over the Austrian, German, French and Slovenian prices. But also the power of the supply was in very few hands. So in early 2000s I saw a number of newcomers where it was people investing in CCGTs, wholesalers buying capacity from one country to the other, trading companies, and the pressure on prices became to have an effect. And if we looked at the first decade of the 2000s, even though there was a commodity boom, so oil went from 20 to 150 and all the commodities rose, metals rose, power prices were under pressure. I mean, and they started diminishing and the spark spread started sort of coming under pressure. A lot of excitement, a lot of American companies coming into Europe, trading the markets, a lot going on, but prices were fundamentally coming off during these years. What do we saw afterwards? We started seeing some defaults. People that had invested in CCGTs started suffering negative spreads. Trading companies that were selling power without hedging themselves, hoping that market would continue forever to come down, so buying then spot to get their supply needs, started seeing an inversion in pricing. And because of bad risk management, we can name tens of companies gone bust over the years. I think there's been a switch at a point in time where market has been fundamentally moving from few incumbents, dozens of hundreds of little players. I think we're seeing now, I think it is a fact that we are seeing now a reconsolidation in the market setup, and either wholesalers been merged with other ones to have more solid balance sheet. Some, as I said, have defaulted, and I think there's a power coming back to few incumbents in terms of making the prices. So I think pressure on downward trend has definitely inverted. Spark spreads have became more healthy over the last 2 or 3 years, and I think the market will reconsolidate over very few large players that have enough balance sheet. If you also look at what happened in terms of exchanges, a lot of the market activity in derivatives hedging has gone from OTC to exchanges. That because of the regulator been very wise in thinking that the intermediary houses and the exchange will solve the problem, but actually that has increased the problem, because with volatility and with initial margin, daily margin posting, a lot of companies have gone bust because they couldn't meet the posting demand. Lately we've seen some issues on the emission market. Emissions have gone from 12 to 25, 24 in few months. A lot of people were caught short. The shortages has caused a lack of liquidity in some players, and then the unwind of the market that has happened from 24 to the prices that we're seeing now 16, 17, and that is because mainly margining activity. So volatility is going to help. Volatility and people that haven't been risk managing properly their balance sheet will cause a market to reconsolidate in few names. not only the incumbent, some more few large names, but there's no doubt that I think the overinvestment in capacity and the over the over concern of regulators wanting the markets to move from OTC to fully regulated has created disruption, and the disruption has caused some smaller people to go bankrupt or to exit the market or to merge with others, and hence we will have and again over consolidation. I can see power prices going up for the next foreseeable future, as long as it is easy to predict prices. On the other side, there's been a switch from oil to initially coal, but as you know, some countries like Italy have decided to totally exit coal from 2025, and I think more will follow. And I think gas is becoming more and more important. We have seen a massive increase in gas availability across the world. We've seen US becoming a net importer to a net exporter of gas. But I think the importance of countries like India, which hasn't kicked in yet, to be honest, and China will increase a lot, and they will be buying more and more gas over the years. I mean, a 1% increase in China consumption in gas means massive demand in terms of terawatt hour of gas. The market of LNG, which was a very rigid market, also has changed. We've seen many players now becoming interested in the market, setting up a spot desk to trade LNG. The inflexibility and the rigidity of the LNG market has shifted. It's become a more flexible market, and all that is to accommodate the demand clearly from Europe, but also more and more from China and India, which are building massive regasification infrastructures all over the place. Hence, personal view, and his personal view is that energy markets will see a rise in demand, and in power prices over the next few years. I haven't prepared much, so I'd like to maybe get some question and answers if that is the case. Thank you.
So quite impressive to have this structured speech without slides and preparation. So thanks a lot. I think we have one or two questions now, and then I would propose having a good coffee before we go to the next one. But no. So maybe they have to sink in after some coffee. Could possibly be. So thank you very much again.
Thank you.
We will be back at the time is not here actually, but I think it's in 20 minutes. I actually moved to an analog system recently. Actually 11:30. Good to be back here. I hope you had a good coffee. I had to actually walk 20 minutes to get a coffee and come back, but I enjoyed it. So I hope you did as well. And so we had quite some interesting presentations on different perspectives in the morning. And I'm very happy to introduce the next speaker. And he is from UpData, and he will give a more technical presentation with the title Likely Sentiments and Technical Drivers for Energy Prices in the Month Ahead. So that's a different piece of cake, I think, but I'm actually quite looking forward to it, so I hope you too. Please, David, Linton, very welcome, and take the stage.
Okay, so I've got quite a lot of slides to get through here, so just a little bit about my work. A lot of traders who trade power and gas in Europe use UpData. It's a piece of software to do their technical analysis, and I'm a technical analyst, and technical analysts basically don't look at fundamental data. We look at just the price action to decide the future. And so I spend a lot of my time sitting at trading desks with clients analyzing charts, and so I'm going to do a chart analysis of most of the products that you would be trading in Europe. So as a technical analyst, we work on the basis that price and value are completely different things. So most of the talks you've been hearing this morning are all about the fundamentals and why power price should be this much and why the gas price should be this much. From a technical perspective, we don't care. We work on the basis that all the information in the chart represents everything that the market already knows about the price. And our view is that if it's not reflected in the way the chart is behaving, then you've got no real way of knowing about it anyway, because the chart, it's an efficient market hypothesis. The chart reflects everything that everybody in the market already knows. We did start by saying months ahead, and people always say to me, "Oh, are you bullish on power?" And I say, well, depends on your time horizon, because I might well be bullish for the next few days, but bearish for the next few weeks, and bullish for the next year. It just depends where we are within those trends within trends. And this is one of the things that people really struggle with. And of course, fundamentals don't really do. But with charts, because we can look at 60-minute charts, daily charts, weekly charts, 1-minute charts, because we can take the time frames and make them different, we can then actually start talking about different time horizons. So the simple way to think about it is that daily charts mean weeks, weekly charts mean months, and 60-minute charts mean days. Now, we did say months ahead, but in fact I'm going to talk about what's happening in terms of days, weeks, and months, and maybe even longer term. The charts that I mostly use, and people normally glaze over when they see these, but the charts that I mainly use are two technical charts called Ichimoku charts or cloud charts, which are the ones on the left, and point and figure charts, which are the ones on the right. And typically, and point and figure charts have been used for over 100 years, and they give you the ability to project price targets of buying or selling thrusts, and that's how they work. And these are all automated within our software, so a lot of power and gas traders are looking at these targets constantly, and I'll go through the charts with these on. And across here on the top, my weekly charts, my daily charts, and then my 60-minute charts at the bottom. So it's long-term, medium-term, and short-term. So I can be bullish long-term and medium-term, but actually bearish short-term. And if you're a trader, you kind of want to know that prices are going to fall before they rise, or that they're going to rise before they fall. So it's just knowing where you're sitting in terms of that. We put out a morning call every morning where we talk about price action that we expect for the day ahead based on the charts, and I record a Charts Today Energy, so I did it this morning, so I kind of have a handle on where the market is today, and I record that on YouTube every morning, and it goes out to clients. So I'm actually looking at these prices all the time. But starting with the markets in macro, and that's normally where I start, is what are the big things that might be affecting price action. And about a year ago I spoke at a conference similar to this, and this chart's actually a year old, and I talked about euro weakness long term, and this is a big driver for what could happen. And I said that 120 was the critical lever against the US dollar. In fact, and that we were in this big downtrend on the euro. Now, this could take years to play out. It's not something that's necessarily that means that the euro will fall tomorrow. And in fact, if we look at the chart 1 year on, the euro did go above the 120 level, but it hit resistance, and it's now falling away. And those of you who are technical might recognize a little sloping head and shoulders there, where we actually have potential to fall further. And 105 is the support level for the euro. And if we fall through 105, then almost certainly the euro will be worth less than $1. That's a technical thing. Once we fall below that level, the confidence in the currency goes, and we suddenly find that the euro is looking very weak indeed. And so that could have a very big dramatic impact over and above anything else I talk about. So that's the really big picture thing that could happen. And this might take, as I say, years to play out. The dollar, this is the dollar index. The dollar is actually looking quite bullish. So on the top left-hand chart, it's starting to go into bullish territory above this cloud. It's a bit like moving above a moving average. In short term, it's bullish. The medium term, the medium term is bullish. It's the middle chart, and the short term has actually been a bit bearish. And with the US elections last night, the dollar fell back a little bit, but the long-term picture for the US dollar is still pretty bullish. Euro is actually starting to weaken. It's the converse of that, of course. So with the euro, we are actually seeing real risks of the euro going lower, and we've got some pretty scary downside targets on the right-hand chart there, way below parity. And so there is just this, from a chart perspective, there is this big fear that sits there that the euro could collapse. And I don't know what that is. It could be a crisis in Italy. It could be something that comes to light. But the charts are saying there is a risk of a big fall in the euro. It's not necessarily going to happen, but the charts are pricing it in and saying it's looking scary for the euro. Of course, when we get to other things, we've got Brexit uncertainty, and we're seeing here that actually sterling has been, again, lots of big downside targets to parity or lower on the sterling chart, but actually sterling's looking a little bit stronger because the market's starting to price in that a Brexit deal will get done. But of course, that creates scope for disappointment. If a Brexit deal doesn't get done, then we will probably see a sharp reaction to the downside. I say here the only certainty is uncertainty. Looking at sterling against the euro, sterling is actually currently short and medium term much stronger than the euro, and this almost implies that Brexit could be worse for the euro than for sterling. And so again, it's just what the charts are saying. At the moment, the sterling chart is starting to look a lot stronger than the euro chart, so that's been quite an interesting factor. The market is pricing in a Brexit deal. US stock markets a year ago, I got them down the bottom here, and I kept that. I always like to keep what I said a year ago, was saying the markets were looking bullish, but US stock markets now are looking less bullish, and we're seeing a lot of this, and this is sentiment that might play through to energy trading. We're seeing a lot of negative sentiment kicking off, and this is, all the sorts of reasons that you want to talk about China trade wars, but from a technical perspective, we don't really care why it's happening. We're much more interested in what's actually happening. And the fact is that these markets are starting to break down. And in Europe, this is the UK, Germany, and then we've got Asia. China's already down 30% from its peak and making 4-year lows. We are starting to see sentiment turning very bearish in Europe and especially in Asia. And again, these charts a year ago were looking much better than they are now. So we're also seeing on the converse of that gold, being a proxy for uncertainty, is actually now starting to roll up into a more bullish trend, and we're seeing gold as a safe play where people are starting to move towards as well. So that's the big macro picture, and I always just like to start with that, but then getting to the energy drivers, which is really where we want to be looking first. Of course, the big driver is crude oil, and we've seen over the past year a real unexpected strength in the crude oil price, hitting $90 there at one point only several weeks ago. And what's interesting is this middle chart, the red chart, is actually a seasonality of crude oil, and so this gives us an envelope based on the previous year's price action. This gives us an envelope for the year ahead, and we normally expect crude to rise quite strongly in the first quarter. It did this last year, it did the year before, and so whilst crude prices are coming under pressure at the moment, don't be surprised to see a recovery in the crude price in the new year. Now that might be a weak recovery that only goes on for a few months before we then fall away as part of a bigger downtrend in the crude price. But interestingly, crude has been looking very strong up until the last few weeks, and we'll look at the shorter term. And the correlation with the US dollar is normally negative. That's a 65-day rolling correlation with the US dollar. So normally if the dollar goes up, crude inevitably falls, or commodities fall. And so that dollar strength chart is a potentially quite big driver for the crude price, which will then have impact on other parts of the energy mix. So looking at Brent, at the moment, and I say this, Brent's up 2.5% at the moment as I speak today, so this is where you can get a sudden counter-trend move, but crude oil prices have been looking especially weak. in the last few weeks and certainly the last week or so, and we're seeing really the crude price finding support at the moment around $70 for Brent and $60 for WTI, and we do have downside targets below that. So it is coming under pressure, but this could be the sort of final sell-off that we see in crude running up to the Christmas period, and then we head into the strong quarter where we might start to see a sharp recovery in the price. Whether we'll go back higher than the $90 at this stage is hard to say. We don't have any short-term targets indicating that, but don't be surprised to see it recovering some ground. The targets on WTI are less clear, but this middle left-hand chart is showing that medium term we have been falling into bearish territory for some time on WTI, so we are just seeing crude prices coming under pressure. One of the big surprises has been the US nat gas price in the last couple of weeks. The last week really, it's just rocketed, and we went from $3 to $3.50 very, very quickly, and we've been making highs not seen since the start of the year, and now that high is coming under pressure. We're starting to see potential for 3 and 4 year highs in the US nat gas price, and we've got a target actually of above $4 on US nat gas that's been generated from this big thrust, and the way that thrust works is all the buyers come in, and if they stay there and we push higher, that then gives us a potential target to where the price might actually go. So US nat gas is actually looking, among all of the energy mix, it's looking like the strongest product at the moment. But we've seen quite a lot of false dawns on nat gas, and we can see that coming away. In Europe, we're seeing coal prices falling. Yesterday we were hitting on API2, we were down to 89.50. We are seeing coal prices coming under pressure. We heard lots of discussion and argument about the fundamentals for why coal might be falling, but the charts have been showing that downward pressure. And this is my screen that I use for my morning call. It looks a little bit complex, but I've got just going from the top, I've got a weekly chart, then my long-term point and figure charts, the daily charts, and then I go into my 60-minute. And right in the bottom two, and the bottom right-hand corner, are my 1 minute charts. And so the beauty is I can click on a product and I get that multi-view of what's happening on that product. And if you ever watch me do my morning calls, I do this in minutes, and traders want to be able to do this quite quickly. So inevitably the short-term picture is changing very quickly. The very short-term 1 minute chart is changing all the time. The daily charts take some time to change, and the weekly charts will be in that position for many weeks. So at the moment the coal price looks bullish on the long-term chart, but we're seeing on the medium and shorter term charts it's starting to look bullish. And of course, if we do turn to long-term bearish, it will have happened in the shorter term charts first. So coal is coming under pressure. The carbon price has been also falling quite heavily away from that peak that we saw. This is the December contract on ICE, and we're seeing here that we do have downside targets, although these charts were a few days ago, and this morning we saw a kick up in the emissions price, so we are just seeing quite a lot of volatility there. The 1 minute charts for emissions are really important because the picture can change very quickly, but the medium term picture is just turning quite bearish. We're short term on the 60-minute chart in bearish territory, and the long term chart does really look like it's rolling off the top. So at the moment, seeing emissions going higher than that high that we saw back in August time, it's really looking unlikely. So it does look like emissions are going to fall further. Looking at gas prices, I'll start with NBP. Again, this is the ICE contract. If you're using data from Trayport into Updata, then you'll have higher liquidity on the screen, and you'll have slightly different charts for the shorter term targets and things. But here we see NBP, seasonality-wise, it tends to rise in the second half of the year and fall in the beginning of the year. This is the front month contract, and the correlation with crude oil is, of course, very strong. So if crude prices start to go up, then there's no big surprise that will have quite a high impact on NBP. And front month NBP, we're seeing again downside targets here, although again this morning NBP prices were opening up some 1.5–2% higher, and we do have some short-term upside targets, and that might just be a counter trend move in a bigger sell-off. So gas prices, again, we're seeing really the whole energy mix since that crude high. We're starting to see a lot of these products coming off the top. TTF, we're seeing some quite big downside targets potentially here as well, and that's pushing lower as well. I actually need my glasses to read those targets. You're probably wondering what they are, but we've got as much as 7, 14 and 20% downside, and obviously the 7% target is going to be met before we see the bigger targets. But at the moment we are seeing some quite bearish pictures there on MBP. And these are the 1 minute charts for TTF. This is again 5 days ago. We will have had lots of price action since then, but you can see targets that were given only a week ago were met, and now we've got really a further downside target of 8% lower, but we might now have some new price action that's come on that's giving us some very short-term targets. Now, looking at power prices, of course the main contract is the German power calendar contract, and that also is coming off the top. No big surprises there. We've got downside targets potentially here, some 8 to 16% lower. So we could see the power price falling lower. We're starting to enter territory where we are more bearish medium term on power. But again, yesterday we had some very good little upside targets on the power price. They were given yesterday, met this morning on the open. So power actually opened up around 2% higher today. So we are seeing counter trend moves, but the bigger trends will dominate. French power, again, we're starting to see a lot of these products coming off the top. We had a lot of nice long-term upside targets, but now we're getting new downside targets that are starting to dominate. Normally when you get a market's making new highs, the last target that's given is not met, because we then start to go into reverse. And Czech power we're starting to see coming off the top as well. Italian power, and it's pretty much the same picture across the board, where we're seeing the sentiment has changed quite dramatically on power. I put this slide in, actually it's from last year, but just in terms of the forward curves, this is forward curves overlaid on the power price. And what it showed was last year you could buy forward on the power price at around 30 euros. And it was, at that time, what happens when the market recovers, the forward market takes some time to then price ahead, because the market is so beaten up after such a big fall that it's so hard to sell power forward at those prices. Then when the market starts to hit a top, the forward price is now a lot higher. So the interesting thing is that once that trend changes, it generally doesn't pay to buy forward. And so if power prices are falling, of course, if you're a buyer of power, you don't want to be buying. If you're a producer, you want to be getting rid of as much production as you can while the price is actually falling. The trade data is really, really valuable. This is tick data on German power, and we're finding more and more clients, well, apart from using this to generate the price targets, we're finding more and more clients are starting to do automated trading. So we're seeing a lot more of this in the marketplace, where people are using just technical tools to generate trades. And this is one energy trading system. You can see over September, October, power price hasn't been very strong, yet the trading system is managing to lock in any gains and keep pushing higher. This one is one of my favorites. This is a stop loss system where you just flip from a short to a long position, and again, power price falling, but in terms of energy trading, this is exactly what we want to be achieving, smoothing the trading such that we're still managing to go up the hill. So we're seeing, as a feature, we're seeing more and more firms trading energy. So I'm a couple of minutes over my 20 minutes, but I always say good luck, and good luck happens in uptrends, and at the moment it is looking like energy prices are coming under pressure. Thank you.
Great. Thank you, David. Wow, that was quite an impressive presentation. Thank you very much. You said, well, it will be a technical presentation, and it was a technical presentation, but in the end the messages were quite clear. And I think it's overall quite that the markets are becoming more complex, and the uncertainty is still quite high. And also in your presentation, that's one of the messages, I think. We actually, for several reasons, we decided not to have formal panel discussions. So I really would like to invite you for questions for David specifically, and after that we can walk into a more general discussion and before we end. But before we do that, please, any specific questions, right? Yeah. Do you have the mic? Where is that?
It's
It's here. Great.
Hi, very good presentation, thank you.
pleasure.
My question, do you use RSI and ADX as indexations?
So what I find, and I've obviously in 20 minutes I can't go right into, and we teach a lot of trading firms which indicators to use when. So in sideways markets, oscillators like RSI work very well. But in trending markets, the problem with an RSI is it's going to keep telling you in an uptrend that it's overbought, and in a downtrend it's oversold. So you're going to keep getting signals in an uptrend to sell, and you're going to keep getting signals in a downtrend to buy. And so the problem with these indicators is they can be giving you short-term opportunities that are counter-trend. And we would normally say to people, if you're going to trade against the trend, fine, but small positions and be quick, because the bigger trend is ultimately going to come and whack you back. So I'm not a big fan of them, if I'm honest.
And ADX?
ADX, so ADX is a way of really confirming whether you're in a trend, especially the ADXR. Are we in an uptrend or a downtrend? But I think there are better tools like what I'm using to establish that. And again, I think they're just hard to read. And they don't take account of, the oscillators don't really take account of what trend you're in. So you could use the ADXR to, if it's above 25, you're in a trend. If it's below 25, you're not. But I think there are better filters than that.
Thank you.
Pleasure.
Any more? Here in the front, Volker, yeah? 2 points.
Just one question for the macro charts you showed. Could you elaborate a bit more how you determine those thresholds? Because you said previously it had been for the US-Euro correlation, it has been 120, then it's now 105.
Yeah.
How do you really, could you elaborate how you really determine those thresholds?
Right, so basically, and especially in Forex, because it's probably the most liquid market in the world. You know, there's so much news flow in something like Forex, and it's so heavily traded that most Forex traders actually are technical. And so what we see here is over the period of a few years, the euro actually tested this 105 level. This is an area where people were happy to buy the currency. And so what you'd expect is we fall to that level and the buyers should come in. Now, if they don't come in at 105, that's a worry. It's like, well, hold on a minute, they were here last time and now they're not here. What's changed? They're not as eager to buy at that level. That's a sign that there's sentiment. Furthermore, all the buyers that did buy at 105 are now underwater, and they've now got to start to make decisions about whether they cut that position or whether they sit on the loss. So this chart just shows, and you can see, I mean, in 2014-15, we had a very dramatic re-rating very quickly of euro-dollar. And basically, if we break that support level, the real risk is we do the same thing, because markets generally move sideways or don't do very much, and then big moves to re-rate. So I'd be very worried if we spent a few weeks below 105 for the euro, and then I think one would go quite naturally, and then you know, we would be into territory that we haven't really experienced. And people say to me, why would that happen? I don't actually know why that would happen. The charts are just suggesting that, but it could be any sort of black swan event. China is looking very worrying in terms of the stock market. It's down 30%, and we've got downside targets 50% lower. The trade war aspect of things could blow up. It was interesting, a year ago we were worrying about North Korea. Now we've got a new worry, which is the Chinese-US trade war. We're seeing the US dollar pushing ever higher. We're seeing bond yields in the US sitting at 3.2% on the 10-year. We've got targets now above 4% on the 10-year. The Fed might tighten faster than we think, which will then drive the dollar higher. There could be all sorts of reasons that are going to bring this about. Brexit could actually turn out to be a disaster for both Europe and the UK. We've got crisis in Italy. We've got all sorts of things that could just conspire to suddenly hit the euro, and I don't know what it would be, but the chart is worrying. It will only be positive if we can move above this recent high at about 125. If we get to 130, then that whole worry goes away, because suddenly all of those buyers are confirmed. So the classic thing about a breakout is if we break lower, and this is what's really hard for fundamentalists, because if we break lower, it's better value, but from a technical perspective, it's actually undermining and it's going lower. So it's the contrary to what fundamental people will think. If it breaks higher, most people say, oh, it's now too highly valued. But if we break out, then we normally run quite quickly to catch up. Sorry, that's a very long-winded answer to your question, but 105 is the critical level because that's where the buyers have been previously over a series of years. Okay.
Any more questions for David? So maybe a question from what has been the biggest surprises for you over the last weeks?
Probably the biggest, not so much the last weeks, but this euro chart. The euro actually rose against the dollar over the last year, and that was a bit of a surprise because the dollar strength. And this is the thing about long-term trends: you can be right in the long term, but you can be wrong in the medium and short term. I think that's been the big surprise. I'm probably a little bit surprised gold hasn't gone higher, because there's a lot of risk, a lot of worry in the world, and markets are sort of treading water a little bit. Just in terms of stocks, I'm very worried that Apple now is looking quite bearish as a chart, and that's been holding the market up. So just one little thing like Apple's share price collapsing can make markets collapse, can then affect sentiment, that then affects the crude oil price and all sorts of other things. So it's all interlinked, but no big surprises, I guess.
And on the EUA market, of course, it's one of the markets which had really a significant break. It went up quite steeply.
So
This, of course, partly fundamentally driven, but also lots of sentiments going on there.
Yeah. So personally, I hate charting emissions, and the main reason I hate charting emissions is there's so much political risk in that chart that you can't predict. And I say to people, well, you can't predict it on the fundamentals and you can't predict it on the technicals. If suddenly there's a decision that's made or a new policy, that can have a massive impact. And but it's from a chart perspective, and I can only really talk about it from the chart perspective, it really is a very clear break of a quite big trend that we've seen over the last year. And so I do feel big moves to the downside is a real risk. I say to traders who trade emissions, really you have to trade this product quite short term, because I don't really feel comfortable about holding a position on a Friday and seeing where we are on a Monday, because it can change so much in either direction. But the big thing with emissions is it's looking like big targets to the downside, but we might go up quite a bit before we then go down. So that's quite painful from a trading perspective.
So, Peter, you have a question? Yeah.
Hello,
please.
Peter.
Volker, can you do it gently? Yeah, great.
You see that man plays cricket.
Nice to see you here, David.
Yes, you too, Peter.
Probably a silly correlation to ask about, but I'm going to ask about it anyway. You ever do a correlation of crude against carbon price? Wouldn't make any sense to do so, but I just wonder if you've ever done it.
I have done it. I haven't done it here. And so the thing about correlation, so this is MBP just as an example. The thing about a rolling correlation, and I like to use a rolling correlation because what it shows is that the correlation is changing all the time. And so the way I recommend to energy traders trading less liquid OTC products, the way to use the correlation is when the correlation is positive or negative, take that into account as you're trading at that time, because it's going to give you a heads up as to the less liquid products move based on the correlation with a more liquid product. So most European energy products are are normally quite highly correlated with crude oil. So, and we know that emissions have been falling, crude's been falling. So at the moment, the correlation is quite high. The problem with the carbon price is it can just go and do something on its own, and so that's why I said I don't really like charting it very much. At the moment, the correlation is there, and this is of course on a daily chart. If I went to a 60-minute chart, and I do have, so when I do my daily call, I actually look at correlations on a 60-minute and a daily, and quite often the short-term correlation chart is giving me a different picture from the medium-term correlation chart, if that makes sense. So it's always hard to advise without knowing what someone's time horizon is. But I think the bigger thing for me on the carbon price is that red trend in the top left-hand corner has been very clearly broken, and it's hard to call the bottom in terms of where this ends. So I think emissions is the one that could go up quite a lot before it goes down quite a lot. It's just too hard.
Well, just one more question on correlations, if I may.
Yeah.
Do you ever do charts with time lag correlations? Have you established any kind of, let's say, normal or repetitive time lag correlations?
Yes. So you can prove. Well, the great thing about charts is that you can prove or disprove anything you want if you really want to try hard enough, and you have to be careful not to get a hunch and then try and use the charts to prove that hunch. But there probably is a bit of a lag because most of these products trade a little bit more, with less liquidity. But I haven't done enough research to prove anything, I'm afraid. So sorry to not be able to give you anything more positive than that.
Good, thank you. Good question.
I'm surprised no one's asked about the power price. That's where I normally get the questions.
Maybe a question on what is your best working condition, so to say. It's a little bit of a broad question. Well, what market do you feel the most comfortable in? And you can answer.
So from a technical analyst,
you can take your own perspective, from a market design perspective, from a technical perspective, from a liquidity perspective.
From a technical analyst perspective, we always want liquidity. So, part of the problem is that MPP could be in a downtrend, but it opens up 2% in the morning. Whereas most markets where there's liquidity will perform better on the technicals than where there's less liquidity. So if I was looking at the power price, I'm always going to put most of my weight into German power, in the knowledge that most other power markets are going to follow this chart. They might do slightly different things, but it's where the liquidity is. But for me, a chart is a chart is a chart. So I'm pretty comfortable if I can chart it, if that makes sense.
Certainly. So does anybody want to ask the question on power prices? Otherwise, I would like to maybe invite some of the former speakers giving your presentation and your view. Is there any perspective you want to give in relation to this presentation or the more broader view?
I mean, one thing I would say is what happens to power prices maybe if we do see the euro going below 105. And then we do see crude oil sinking quite a lot lower. What is the potential impact then, maybe, on power prices? So I'm less able to say what that will do for German power, maybe, than people who are in the market. I don't know. Do you have a view on that,
Andrea?
The only comment I would make that Italy is not in crisis, is in a negative transition. So it's different.
Okay. By the way, I didn't say Italy was. I said it might be.
Will it change, Andrea?
Yeah.
Will that change?
Yes, of course. After the revolution.
Yeah. But the market's already priced in everything it knows about Italy. So it would have to be more bad than what people already know. So if it's not more bad, then that's good news. But if suddenly it's more bad, then that's bad news. And people always say, what's good? What's the definition of good news and bad news? It's how the price reacts. So, the market can go up on bad news if it's less bad than people thought. So,
And if you would be able to invest physically in something, what would it be?
gold is my big thing. Gold is. I think it's the. I'm very worried about stock markets. I wasn't a year ago. I'm not trying to pick tops and bottoms. I'm just picking the trend change. But it really does look like markets are unwinding, and so that is. I think gold will become a safe haven. But I'm quite interested to trade German power. I'm just starting to trade it myself, long and short. I think it's quite a good product to trade.
Thanks a lot. So, if there are no burning questions, and then I think I would like to say something about the whole session. I really enjoyed it. Thanks a lot for all the speakers. The good thing about this session, from my perspective, that we had quite diverse speakers. So we identified the global trends, but we also went into different countries like Germany we had, and also from a technical perspective we looked into the different markets, which is really makes it really lively actually to understand those markets. So thanks for that. And there's this. I would like to end with this quote. I think it's from Voltaire. As uncertainty is not a pleasant condition, but certainty is absurd. So thank you for your participation here. Have a nice lunch and have a nice day at the European Utility Week. Bye.